In 1980, bank deposits accounted for all financial assets, 42% of production. By 2005, this proportion had dropped to 27%. In the banking system, the capital market is increasingly playing an intermediary role. With its long-term loans to customers and long-lasting relationships with TM, banks have transformed from commercial banks to investment banks. Thirdly, a large number of complex new financial products are derived from traditional bonds, stocks, commodities, and foreign exchange come on. Derivatives were born from this, with options, futures, and swaps being the most well-known. According to data from the International Swaps and Derivatives Association, by the end of 2006, the outstanding book value of interest rate swaps, exchange rate swaps, and interest rate option transactions had reached $286 trillion, approximately 6 times global GDP, much higher than the $3.45 trillion in 1990. These derivatives have changed the opportunities for managing risk. Fourthly, new market participants have emerged, especially hedge funds and private equity funds. It is estimated that the number of hedge funds has surged from 610 in 1990 to 9575 in the first quarter of 2007, with assets under management worth approximately $1.6 trillion. Hedge funds play a typical speculative and arbitrage role, which is in stark contrast to traditional funds such as mutual funds that only engage in long positions, which typically invest in stocks and bonds. In 2006, the total amount of private equity fundraising reached a record high. Data from private equity intelligence shows that 684 private equity funds raised a total of $432 billion. 3. Technological progress and theoretical innovation. Essentially, the financial industry is an information processing industry, and its degree of evolution is closely related to human information processing capabilities. The efficiency of finance depends on the strength of human information processing capabilities, so the importance of the computer and communication revolution cannot be underestimated. It has created a series of complex transactions, especially derivative transactions, enabling us to price them. This has also led to 24-hour uninterrupted trading of massive financial assets. New computer-based risk innovation in securitization and capitalization. The market-oriented reform only shortens the distance between wealth and money, while the capitalization reform is the more important reason for China's increasing money over the past decade. That is to say, capitalization and financialization refer to the conversion of the following 4 major types of wealth into capital, resulting in a significant increase in China's financial capital. The first is land and natural resources. The second is enterprise property and future income flow. The third is the future labor income of individuals and families in society. And the fourth is the future fiscal revenue of the government. These 4 types of wealth are the core sources of capital for any country. But not all countries can convert these assets and future income into capital. The prerequisite for doing so is that the property rights of these capital sources are clearly defined and can be bought and sold, preferably in the form of property rights contracts. So, before the reform and opening up, China was a society with wealth but no capital. In the past, we focused more on the impact of the Industrial Revolution on human society over the past 200 years, but ignored what happened in the past, the 150-year financial revolution. The effect of capitalization is to accelerate the allocation of resources, reduce allocation costs, and improve allocation efficiency. In 1800, the United States, which was mainly focused on agriculture, had an extremely low level of financialization of its economy, with the money supply of only $28 million yuan. The Industrial Revolution and urbanization have led to a sharp increase in the degree of financialization of the U.S. economy. By 2006, the total value of financial instruments and securities reached $129 trillion US, which is 9.7 times GDP compared to every dollar of GDP. Nearly $10 US of financial instruments and securities are in circulation. The degree of financialization in American society has never been so high in history. The high degree of financialization has brought about an unprecedented supply of financial capital. With so much circulating financial capital, the capital needed for technological innovation, foreign investment, and personal entrepreneurship is certainly not a problem. The monetization and capitalization capabilities of the U.S. economy have naturally made it a global financial center, resulting in its financial and related industries accounting for over 35% of GDP. The result of capitalization is that the wealth of the United States can create more new wealth at a management. The theoretical model has been applied throughout the financial industry. The financial industry today is an extremely active product of the computer revolution. The other two long-term developments help explain everything that has happened. The first is the revolution of financial economics. Especially it is the valuation of options model designed by Myron Scholes and Fisher Blake in the early 1970s. This model has become the technical basis of today's huge option market. Secondly, the success of central banks in creating a stable monetary system for the global economy and also for the global financial system. Fiat money, the currency created by the government, has been in good operation for more than a quarter of a century, provide the stability of the monetary system that complex financial systems have always relied on. 4. Leaning anti-regulation under the trend of liberalization. How to explain the enhanced role of financial intermediaries in the financial industry and the increase in industry activity? Answers and economic activities. Globalization is roughly the same. In addition to the promotion of technological progress, there is also the proliferation of economic liberalization ideas. Before the mid-20th century, The financial industry in various countries around the world had been strictly regulated. In the United States, the Glass-Steagall Act 9 distinguishes commercial banks from investment banks. Almost all strictly control foreign exchange and foreign assets held by much faster rate than other countries. China has tasted the benefits of capitalization, but the overall level of capitalization is still very low. The U.S. stock market, bond market, and housing the market value of real estate mortgage loans is 1.56 times, 2.1 times, and 0.9 times GDP, respectively, while the corresponding ratios in China are 0.8 times, 0.01 times, and 0.11 times. Therefore, there is still a lot of room for capitalization in China, which can also provide financial capital for China's economic growth for many years. However, the land is still state-owned, and almost all enterprises are also state-owned, which will continue to inhibit the deepening of China's capitalization, especially if we want to generate maximum capital. The legal framework such as property rights protection and contractual rights protection must also be improved. Otherwise we can only do some rough capitalization operations and it is difficult to deepen. From Zhu Chen's Secret of Capitalization to Quantity Basis in the past decade, developed countries led by the United States have been frantically issuing base currencies. With the United States issuing currency, the volume has been growing at a rate of around 10% for a long time, while the GDP of the United States grew by less than 3% during the same period. Similarly, Japan's base currency issuance has remained at around 10%, but its GDP growth has almost always hovered around zero over the past decade. When normal investment opportunities cannot provide a way out for the capital accumulated by the industry and commerce, it will take the form of financial capital speculation, penetrating and controlling everywhere, especially after the heavily constrained financial industry once again freed itself from constraints. Many new developments emerged, such as new economic activities, new wealth, and new social and political phenomena. Firstly, there has been an explosive growth in financial assets. McKinsey Global S2Ds said that global financial assets accounted for all the proportion of annual output of the ball has skyrocketed from 109% in 1980 to 316%. In 2005, the global stock of financial assets reached $140 trillion. Secondly, the transaction-driven characteristics of financial assets are far more obvious. Residents. Setting a cap on loan interest rates is quite common. The most famous of them is the interest rate cap in the United States. The regulation prohibited the payment of interest on demand deposit, which also promoted the development of the first offshore financial market after the war, the euro-dollar market in London. However, in the past 25 years, almost all of these regulations have been abolished. Commercial banks and investment banks, the boundaries between rows gradually disappear. foreign exchange controls has disappeared from higher income countries and in many emerging market economies. It has also been largely or even completely liberalized. The birth of the euro in 1999 accelerated the integration of financial markets in the world's second largest economy, the Eurozone. The openness of the financial industry in many countries around the world has reached the level of 100 years ago, just before World War I.